Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing car parts. Carparts is an online provider of auto parts and accessories. The company sells 1.2 million different items. About 40% of its sales are through eBay and Amazon. The other 60% are through private labels. The company is headquartered in Torrance, California, and was founded in '95. The ticker trades on the NASDAQ. Let's get started with the model. This is a micro-cap company, 238 million market cap. They're trading at $4.36 a share, and they have 54 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small positive in 2019, negative after that. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative each year. Revenue looks really good. It more than doubles from 2019 to 2021, then grows even more to $622 million in the trailing 12 months. Let's look at the capital structure. 108 million of equity, 49 million of debt. They're 69% equity, 31% debt. Their net debt is 34 million. Net debt is debt minus cash, so that means they have 15 million of cash on their balance sheet. They do have a high WACC according to Finbox, 9.8% to 11.8%. Let's use the middle one of 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a valuation of $765 million. We divide that by 54 million shares. And we get a calculated stock price of $14. They're trading at $4.36, so they're trading at a 69% discount. It's a really strong buy according to the model. It is tough to value this company since they're not cash flow positive. They do forecast their revenue to hit $944 million by 2024. 776 million by 2023 and 668 million in 2022. If I continue this trend into 2025, they'll be at 1.1 billion. I think that's a sweet spot, 1 billion of revenue. Companies like this can easily convert 15% of their revenue into free cash flow. I just assume an 8% conversion in 2025. And even if they do that, convert 8% of their revenue into free cash flow, the company still seems really undervalued, but they have to get to that point where they're generating positive free cash flow. Because if they don't get to that point, then they're worth nothing. There are 48 companies in the same industry as Carparts, and they're ranked 27th in market cap. They are a pretty small company. There's a lot of really big companies in this industry like Amazon and Alibaba. When a company's real small, they usually don't take on debt. Mainly because they can't get good terms. That's why they have a good debt to equity ratio. They do have a much better price to book than the average, mainly because they raise so much cash from going public and the subsequent capital raises. They have a really solid price to sales ratio. That's the number we should be looking at. When it's 0.5, that means their revenue is double their market cap. They're 0.4, so their revenue is more than double their market cap. They are growing at a good rate, 15%. But still below the average. It's pretty amazing how much Amazon is growing at the size they're at, 26%. And they have negative ROA and ROE, which are better than the average because most companies are negative in this industry. So to summarize, I have them trading at a 69% discount. It does seem like a good business model, and they do seem to be pretty well capitalized. I did give them a 2 in free cash flow, 2 out of 10. It is still negative, but they are maintaining their negative, and it seems to be improving since 2020. They have really good revenue growth. I gave them 7 out of 10. Ratios are decent, 5 out of 10. Okay, buddy, I guess this video is only for you, so thanks for watching.